Thanks so much. So this is joint work with Rui Costa, who's at LSE, and also Steve Machin. So what we're going to do, it's an old labor question, which is what is the connection between trade and labor markets? And what this paper is going to do sort of a bit differently from this really vast literature is to look at an unexpected currency depreciation to get variation for trade changes, which we then look at how those impact in turn worker outcomes. So very quickly, this is of course an extremely huge influential literature where early work really thought about putting in, on the right-hand side of a wage equation, there would be some trade variables thrown in. Most things became a bit more sophisticated. So the paper closest to us actually goes back to 1992, which is Revenga's paper, where trade outcomes are then sort of instrumented with exchange rates to look at what happens to wages and employment. And then, of course, there's the big literature that comes sort of afterwards as well, which is looking at both sort of the Mexican stuff that Feenstra and Hansen did, as well as sort of later China shocks. And what we're going to do sort of is to add to this literature by looking at three things together, which is worker outcomes, trade, and exchange rate movements. And the study of all three is actually quite rare, even though there's some early precursors like the Revenga paper I mentioned earlier, simply because most developed countries, at least at this point, don't really have big exchange rate movements which you can utilize. There's also this other issue, which is that most of the times these papers were really concerned about manufacturing workers, but as we know today, for countries like the UK or the US, the share of manufacturing in total employment is actually quite small. So the bulk of workers are not what we end up studying then. So what this paper is going to do is to look at sort of the current surge in nationalist politics, and also, which is in our case will be the Brexit shock, the referendum shock, and we look at what actual worker level outcomes is. So these are not counterfactuals, these are not price studies about what the trade impacts on prices were, but instead we're going to focus on worker outcomes. So I don't need to say much to this audience. I know heavily European or European sort of come enough to Europe that you've heard about these things, that on June 23, 2016, there was an EU referendum that happened. Everybody thought it would go towards Remain, but of course, it didn't go in that direction, and which is why we're still trying to leave the EU or have left the EU. I always am unclear about which state of affairs we're in. But anyway, the point is that the unexpected result led to an overnight unprecedented fall in the value of sterling. This is the biggest drop that has ever happened amongst the four major currencies of the world since the collapse of Bretton Woods. So of course, if you're going to look at large currency depreciations and try and sort of ascertain from there what happened to prices or to worker outcomes, this is a really good example of that. We're also, to just sort of reiterate that point, since it's the sterling, which is one of the four major currencies of the world, it doesn't only produce sort of one exchange rate movement, it actually changes also what the currency, how different currencies reacted, even smaller currencies like the Malaysian ringgit or others. So what we're going to do is we're going to think of different industries as having very different pre-referendum patterns of trade and therefore being differentially exposed to the sterling depreciation. And what I'm going to try and show you is that the initial trade-weighted depreciation gives you an industry-specific measure of how this particular industry is affected. And from there, we can trace out what happens to trade and finally, what happens to worker outcomes. So broadly speaking, very quickly, just to summarize what's going to happen, we're going to think of industries as having these different cost and revenue shocks. So if I'm an exporter, it could be really great for me. If I'm an importer of intermediate imports, could be bad for me. And in that sense, what we find is that it's really the price of intermediate imports that kicked up after the sterling depreciation. And that wasn't really offset by any kind of revenue gains. Where those increased costs end up showing up also is therefore in wages and training being cut back by these industries for their workers. And these are mostly in the services sector, which is why I was emphasizing that just looking at manufacturing wouldn't necessarily have picked up the kinds of results that we're seeing here. To very quickly summarize, I won't have very much time to show you a lot of the theory and how these things map on, but broadly speaking, if you want to get a headline number, what this is saying is that a 1% increase in the price of intermediate imports reduces the wages of workers by somewhere between 0.2 to 0.4%. We've got new data, the ONS has revised its data, so we're going a little bit more in the direction of 0.2 rather than the bigger number. So let me quickly show you the context of events, then I'll come to what the sort of specification would be, show you some results and discuss a little bit what possibly could be robustness checks. So here's what was happening in the UK on 23rd of June 2016. 10 p.m. is when polls closed, and right afterwards, what happened was a YouGov poll came out, which suggested that 52% would vote Remain, and that's when the sterling basically gets to its highest for 2016, which is 1.5 roughly against the dollar. And so the dark line is showing you euro British pound exchange rate, and the gray line is showing you the US dollar euro exchange rate. And I'm going to keep using this picture to try and tell you what happened during these events, during this event. So quickly, basically what was happening was that before the results actually start to come out, people thought at this point that Remain was going to win and the dollar keeps rising. Then comes sort of the first result, which is here, which is Gibraltar. One person on the island didn't vote for Remain, everybody else did, so no real surprise there. And finally came sort of this big event, which is the vote by Sunderland in northeast of England, which voted to leave the EU with a 61% majority. And that's when basically everything changed that night. Bookmakers changed their odds. People started to do Google searches of what is Brexit, what is leave. If you looked at current commodity prices, those start to rise too. Gold prices go up, US Treasury bonds go up. And broadly, what happens is a flight for safe haven assets. People want to take their money out of pounds and dump them into something else. And those something else would be the ones that they perceive safe during this event window. So what we see, what we're going to utilize is this big unexpected depreciation that happened overnight. So we're only going to use the overnight shock that happened because we think that's the most exogenous, because after this point, at some point, the Bank of England is also going to come in to try and save the pound from really declining further. What we're also going to utilize is the variation across currencies that happens on that night. And the reason for it is that the pound depreciates a lot compared to the US dollar and the yen, and much less compared to other currencies like the euro and the Norwegian krona. So that's going to come in the next slide, which is broadly what you can see here is that big depreciation happens with respect to currencies like the yen, like the US dollar, and the rest are sort of down here with much less exposure. And we're going to utilize this cross-currency variation to be able to think about what happened to trade afterwards, to the depreciation in that particular industry, as well as later on to trade. So I promised myself I wouldn't spend more than 2 minutes on this, and that's exactly what I hope to do. But just so that you can fix ideas and know how to interpret the estimates that I'm going to show you, I want to give you a very broad outline of a very, very standard textbook trade model where you would be able to generate these effects. So let's think of the exchange rate with currency C. So this is, if you think of this as the euro, then what this is saying is that the euro pound exchange rate is determined by some function of the state of the world S and people's expectations of the state of the world S tilde. And really what changes in that and how these sort of international finance and a lot of the finance literature would think of these kinds of very, very small windows is by saying that the state of the world isn't really changing during this time period, but what is changing is people's perception. And in our case, that's the Brexit referendum news which comes in. So that's the change which leads to the exchange rate change. And from there, we can start to think about how that might feed into trade as well as to worker outcomes. And the way we're going to think about that is by saying, think of firms as combining three inputs, labor, intermediates, which could be domestic or imported, and then being able to produce something which is output O. So O is, for instance, cars, L is the car workers, intermediates are the car components here. Wages are going to be set by market clearing industry specific labor. So which is to say, you should be thinking of this more like a specific factors model. And later I'm going to show you some evidence suggesting that there weren't any kind of really big shifts that were happening across in terms of employment. So a specific factors model is actually a good way of thinking about these things. And to close the model, what we're also going to need is some kind of demand side, where I'm going to say that we're going to just think of CES demand with price discrimination across locations, but not within a location. And the reason for thinking of CES demand is because we're not really going to be able to tell you anything very interesting about markups versus costs. We're only going to look at prices. And the nice thing about the CES setting is that we'll be able to map on quantities onto prices, and especially when you're working with services data, it's usually much better measured in terms of prices rather than quantities, and which is why we're going to find it much easier to work with that. So putting all these little pieces together, by Shepard's lemma, what one ends up with is that the percentage change in wages can be related to the percentage change that happens in the intermediate import price index. So if the price of intermediate imports really goes up and workers and intermediates are complements to each other, then we should expect that wages here would drop. So that's the pure sort of elasticity that you would expect to find. The second component of it, so just is the scale effect, which is that every time the exchange rate moved and my prices moved in response to that, my export prices, then it would tell me that if my quantity of the amount of stuff that I was making, if the quantity of exports goes up for me, my workers are actually going to be better off because economic activity has increased for me. So very, very simply put, if you're used to thinking of consumer theory, what this is saying is that here's the cross elasticity across different products, and this is the component which is picking up the income effect. So the pure substitution effect and the income effect is what's getting captured here. The coefficient that we're going to show you is going to be really this theta MW, which of course, if you were to write it down properly, would basically also take the same sign as the Allen-Ozawa elasticity of substitution, which is the pure elasticity between if I increase usage of intermediate imports, how am I going to shift my workers around? That's really the elasticity that it's going to measure. And then I'm also going to show you that the other elasticity, which is the export price elasticity, actually during this period is about 0. And it's not as though this number is 0, there's not much of a price effect that's happening or the quantity effect or a quantity effect that's going on the export side. And which is why we don't pick up anything here, and the paper is really going to be about identifying this elasticity of intermediate imports and wages. So just to interpret these numbers, if this theta MW turns out to be negative, what it's going to tell us is that a 1% increase in intermediate import prices is reducing worker wages, which means these are really production complements in production on the production side. And that's what I'm going to show you towards the end. So from that model, we can basically operationalize these two equations, which is the reduced form for trade prices. And the way we're going to implement them is a different diff and reduced form, different diff for trade prices, which is on the left-hand side, log of the import price index. So this is how expensive are my car components if I'm in the car industry. So O is output, Q is quarter, T is time. And we're going to have quarterly numbers for these things. On the right-hand side, the key variable that we're going to look at is the depreciation. So this is the share-weighted, intermediate import share-weighted depreciation for that particular car industry. So what it's capturing is how much do I buy of car components? So how much do I buy of seat covers from China? How much do I buy of engines from Europe? All of that, we're basically taking the shares and combining it into one basic index that comes here. And of course, interacted with post, which is anything after June 2016 is going to turn on to post equal to 1. And what this is going to then tell us is that for this particular depreciation episode, what was the change in import prices that happened? And similarly, we can set up an equation for the export side as well, which would have both the depreciation, because the costs could be going up on the intermediate import side, as well as the appreciation, which is then the export share weighted the negative of the depreciation, just so that we have positive numbers everywhere. Let me talk a little bit about what else is going into this equation. Of course, we're putting in industry fixed effects because we're interested in the within industry change in prices and depreciation. We're also putting in quarter time fixed effects, and then there'll be other controls like demographics for workers, which will come into being, which I'll talk about in more detail later. So the next equation that we're going to have is the third reduced form, which is for wages, which is one of the employment outcomes that we're going to be interested in. And there again, we're going to get this depreciation term and the appreciation term coming from the import side as well as the export side on the right-hand side. These are hourly wages of workers at the worker level from the UK British Labour Force surveys. And putting these three reduced forms together is basically going to give us the structural empirical relationship that we're interested in, which is how much does a change in the intermediate import price index change wages. And let me move on to first talking about the data, then I'm going to start showing you the results. I'll give you a very, very descriptive feel of everything that's happening in the data and then the final results. So we're going to use individual and industry worker level outcomes, which are going to come from a number of different varieties. The time frame that we're going to cover, the pre-period is going to be 16 quarters, 2012 Q3 to 2016 Q2. So then the referendum happens and the post period is going to be 2016 Q3 to 2018 Q2, so 8 quarters after the referendum. The data that we're going to cover is basically 85 industries, which on average have about 100 currencies that they buy from and about 198 currencies that they sell to. The workers are going to come, the worker level information is going to come from the quarterly labor force survey. For those in the US, this is sort of like the CPS of the UK. On the trade side, this is where the UK data is particularly good, which is that they collect very detailed information on services trade, asking firms not just how much they import, but also how much they import from which country, so that you can actually construct the trade shares at a very, very detailed level in the services trade data, which is at the destination export. So this is how many cars are going to Germany, Japan, etc. This is telling you where are my car components coming from and which car components are coming from where. On the good side, we're constrained the way most of the trade literature is constrained, that we don't really always know what is happening, sort of which input is being bought to use from which country in the industry. And instead, we're going to have to interact them from the trade data, the ComTrade data, and the IO table. So let me move on to sort of showing you first a quick summary of results. So which are the more exposed industries, which are the less exposed industries. Then I'll show you as descriptive diff and diff, just in terms of what are the basic results for prices as well as for the worker outcomes. And then I'm going to get to showing you the main results afterwards. So here are broadly the top 4 industries in terms of exposure to intermediate imports. So which are the big industries that are buying a lot from countries like the US, like Japan, against who the sterling really depreciated. And what you can see is that the big one, of course, this is the UK, it's London, it's financial services, no surprise there. Also lots of biotech, R&D services type of activities. And if you look at the bottom end, those are mostly sort of heavy items being brought in to make manufactured products from Europe largely. And just to quickly point out here, a lot of what you'll see in terms of the variation is that, yes, financial services is mostly done with the US, and therefore that has a big component. It has a big share in terms of what goes into constructing the depreciation here. But that's not to say that the other smaller currencies don't matter. They also play a role when you look at the entire sort of gamut of things. So here are the difference results, and let me just break down what's happening. So this is telling you the intermediate import price index for the car industry in quarter Q at time T. And what we're comparing is the post pre-referendum changes. So we're looking at what the change has been in the intermediate import prices across these different industries. And what are these different industries? We basically just rank the different industries according to how much of an intermediate import weighted depreciation they faced. And these are the really exposed top quintile into the highest quintile versus the bottom quintile, which is not very exposed. And immediately what you can see from here is the clear DID, which is that there's almost a 4.4 percentage point higher increase in intermediate import prices in the really exposed industries as opposed to the less. In terms of export prices, we don't really see much of an effect. And I'm going to show you very quickly on the next slide that even if you did the separation by the export weighted appreciation, you're really not going to see much action. On the wages, we already see a negative. And in terms of training, we also see a negative. The number looks really tiny for training, but remember, only about 12% of UK workers actually get any job-related education and training. And the reason this matters, and of course, the reason the title is called Deskilling, is for these two factors, that there seems to be a reduction happening on wages and training. I'll skip over this just to very quickly, though, make that point that if you look at here I've put the depreciation, and here I put intermediate import prices, you can see a clear upward sloping line. And I want to beleaguer this point a little bit more. The size of these markers is basically employment, how big that industry is. And what it's already showing you is the circles are services and the triangles are manufacturing. So if you were only looking at manufacturing, you're clearly missing a very big chunk of the entire workforce. On the export side, we don't really see any of this, pretty flat line there. In terms of wages, big downward slope here. And in terms of training, also a downward slope. So let me then go on to showing you the main estimates. So, as trade people, we're probably more comfortable looking at the estimates rather than always the pictures. And here's what this is telling you, that a 1% higher intermediate import depreciation would have increased the intermediate import prices for the industry by about 0.38%. And we can do the same thing for export prices, not much action happening there. And what I'm going to show you next is basically to say there are some pre-trends in this data, so you have to be a bit careful. And when we do that and adjust for those things, we still get very much the same kinds of results. So moving on from there, I'm going to show you the reduced form for wages, and then finally the IV. So what is this doing? This is basically saying put log wages of workers. So the number of observations, as you can see, has really gone up because now it's at the worker level. And what this is telling you is that log wages, when regressed on the reduced form, which is depreciation and appreciation, gives you about an estimate of minus 0.18, which is to suggest when the depreciation happened, worker wages actually went down. And the number ranges from somewhere between nothing. It doesn't even move very much. It just moves from somewhere between 0.14 to 0.20 on the high end. So the IV, then putting those different reduced forms together, will give us the IV. And this is the number that I quoted in the beginning, the headline number, that a 1% increase in the intermediate import prices is going to amount to about a 0.2 to 0.4% drop in wages. And we can see similar sort of idea for training as well. And let me move on because I know I'm short on time. These are the numbers basically saying that if you did the same thing with hours, with inflow rates, outflow rates, employment growth, no action there. So it really is a wages and training story, or a little bit on overtime, which has also been documented previously for US manufacturing workers. So once more, what we can do from here is we can try to sort of plug in the numbers for what this theta MW are, what the deep parameters are. I didn't show you this number earlier. I showed you one where the demand factors weren't being taken into account, but if you even take the demand factors into account, the broad idea here is that the numbers are really negative. And what they suggest is that the Anand-Nozawa elasticity of substitution is also negative, which means that there's a production complementarity between intermediate imports and workers. I'm going to stop here with a conclusion because I think it's better to leave. I know Beata is looking at me a little bit forcefully now. So what the idea here is that if we look at the pre-referendum period, and I'm separating the different industries in the UK to those who are above median exposure, the light line, and those who are below median, so who weren't very exposed to this depreciation shock, we see that they're fairly similar in terms of real wages before. But by the time you get to the post-referendum period, this gap really widens out. And to give you sort of really quantify that number for you, before what was happening in the UK labor market was that across both of these types of industries, there was about a 1% annual real wage growth rate that was happening. After this time period, the really exposed above median industries see a minus 0.6% real wage growth, while the other industries see about a 0.4% real wage growth still. I'll stop here.
Thank you very much, Swati. And we have already first question from Jan Schimmick. How should we think about wage stickiness in the UK, given that this depreciation was a one-time event? And can your estimates on wages be interpreted as a lower bound of the wage response?
So, I mean, would you want to interpret this as a lower bound or not? I think we've been fairly conservative in terms of how much we've sort of said. So I think, yes, it may be a lower bound. In terms of sort of whether what this is doing, you're right, is how do we think about sticky wages? So one is that the real revision in our case, it isn't as though the next quarter wages went down. Wages did take 2 quarters to sort of react. And one of the reasons we think that happened was because you come up to Jan 2017, Jan is when a lot of the wage contracts get renegotiated. And that's why a lot of the sort of movement happens there. So in that sense, wages aren't really sticky. And in principle, actually, my co-authors would say that wages, even in nominal terms in the UK, are not sticky. There have been nominal wage cuts before. And what this is really doing is doing a real wage cut. So you're letting the inflation sort of kill it as well.
Thank you. And there's a question from Viktor Slavchev. At what level is the wage regression? Is it individual or industry level?
So the wage, sorry.
Yeah, and if I may read, so firms have two adjustment margins. They can reduce wages or working hours or even fire people. So do you consider this when creating the sample?
Yeah, exactly. So, I mean, I think those are really great questions. So in terms of the wage effects, what we have looked at sort of both wages as well as working hours. Sorry, I'm going too fast. Wages are done at the worker level, which is why there are 112,000 observations as opposed to 2,000 observations in the previous picture, in the previous set of regressions, which were at the industry level, which are the trade price information. When you get to the sort of training level, that's also at the individual level. That's from the quarterly labor force survey. There is, of course, this issue that which margin do you want to adjust on worker outcomes? And you might want to do it on hours, you might want to do it higher and fire workers. And that's why we tested all of those different kinds of margins. We don't really see any big shifts in employment, inflow rates into the sector, outflow rates, employment growth, hours worked. None of those really move in a big way. What moves is basically wages, training, and overtime hours. One way of interpreting it is that these are flexible margins of adjustment. It's hard to lay off workers immediately. It's not that hard to cut a training program. So that could be one aspect of what's going on. I think that answers that. So.
Okay, so now Carlo wanted to ask a question. Carlo, you're on.
Thank you, Beata. Hi, Swati. So my question is related to a comparison with the China shock. I think you mentioned it at the beginning of your paper, where also you would have a depressing effect on wages, but it seems the nature of the shock is very different, because there you have a shock on prices of final goods in the manufacturing industry, while here you have a shock on intermediate prices affecting all industries altogether. And if I've looked at your graph, it seems that most of your action comes from the services sector compared to actually the China shock, which instead comes from the manufacturing industry. So can you just compare that, though the effect on wages looks the same at the aggregate level, but probably there are distributional effects that are very different because of the different nature of the shock. It would be very interesting to, let's say, know a bit more about those two things.
You were so right. I mean, the China shock is really about first thing, it's happening in industries which were already declining. It's happening to manufacturing workers only. Very specific said, this is a much, much broader shock in that sense that it is affecting the entire sort of workforce. So in that sense, yes, it's a different shock, and maybe, comparing the aggregate numbers is not that useful because it does produce different reallocation effects here. And that's certainly happening. So I know I shouldn't be the one really saying this, but yes, maybe Brexit was actually a good thing for inequality, because most of our action is happening on graduates. By that, I mean college graduates, not really on the non-graduates. So in that sense, yeah, maybe this wasn't such a bad thing if you wanted to think about inequality. Of course, that's a different thing, that the people who are not, the sort of the non-graduates are still suffering because of the price index, the real prices being increasing at the same time. So we have tried to compare it with the Hummel study with Danish offshoring, and that is the China, I mean, not quite the China shock, but definitely manufacturing. And we find that our numbers are actually, in terms of the estimates, are bigger, about double or about 3 times the magnitude is bigger. But the numbers in terms of what the graduate, non-graduate premium is actually very much in line with what they're finding for the manufacturing workers. So in that sense, I mean, there are some parallels, but not full parallels. So broadly, that's the answer. Beata, can I take these 2 questions that are on there? Or
Yes, please. So just to make sure everybody can hear them. So question from Mary Amiti: why aren't you finding any effects on the export side? And question from Fadi Hassan: how do wage effects map into the Brexit vote?
Okay, so I'll take Fadi's question first, simply because I actually don't really know the answer, in the sense that TMO Fetzer's work is trying to do that, which is trying to trace out the geographical distribution. My guess is much of the impact that we're picking up is going to happen sort of in the southeast of England rather than the north, which is, less in these kinds of high-end service activities. In terms of Mary's question, I mean, really great question. We have read a number of your papers, really thought through it a lot as to why we're not picking up export effects. And this is not just our work, but also stuff that other people have been doing using the customs data. Now, with the caveat that that's goods trade only, and that's only non-EU transactions, but you can still see that your typical explanations aren't going to work, which is, it's not got something to do with currency of invoicing being mismeasured or some such thing. What really, in our case, what we are finding is that, yes, there is some negative we can pick up on trade quantities with respect to, so the cost, intermediate import costs rising is having a knock-on effect on the export quantities dropping. And there's a sort of, I don't want to go too much into this, these are still new results that we're looking at, which is that we think that there is some level of trade uncertainty, which is playing a role on the export side. It's not actually playing any role on the intermediate import side. But if you start constructing measures of uncertainty or of trade barriers and so on and so forth, they will kick up in the export equation. I can't show you those results because we still don't have them for public release.